Eurozone banks are profitable, but the benefits from higher interest rates may be smaller than expected, according to the deputy head of the single currency area's monetary authority. The official noted that while most of the tightening has been done already, more rate increases are to come. The turmoil in the Eurozone's banking sector has been short-lived due to limited exposure to bank stress in the US and Switzerland and shielding regulations, Vice President of the European Central Bank, ECB, Luis de Guindos said during a banking conference in Spain. While higher interest rates boost banks' net interest income, the benefits could be somewhat smaller than previously anticipated given a slowdown in lending growth in the inversion of the yield curve, de Guindos said in his speech published by the ECB on Wednesday. The ECB is trying to bring inflation in the Eurozone down to its 2% target. While markets are betting on another 2 increases, some members of its governing council have indicated that rate hikes may continue beyond the summer. Vulnerabilities persist, and we need to closely monitor the situation to safeguard financial stability.
Very clear at the last meeting. She doesn't think that they are in restrictive territory yet, and she clearly thinks that they need to get there. So the question is whether something cracks before they get to 4% or even beyond that. Clearly, credit growth is starting to slow down, and we may get some better news on inflation. But for the ECB, as with all the other major central banks, like the Fed and like the Bank of England, it really comes down to what happens regarding the labour market. So, no, we're not forecasting 4%, but could they get there? Absolutely, it's a possibility.
I wonder then, when you talk about the labour market, the picture in the UK is obviously so different because of Brexit. We know that's one of the factors that's taken workers out of the economy here. How different is the picture to the UK when you look across the rest of Europe?
Well, labour markets everywhere have been suffering from a relative shortage of available workers. Certainly we had the UK labour market release earlier this week. There was something for the hawks in there. There was something for the doves in there. We did actually see a slight downside surprise on some of the headline earnings figures. It's just ex-bonuses. It was quite worrying as well. So the UK has got particular Brexit-related labour market issues, but Europe, of course, has much more use of things like short shift schemes. So it doesn't generate slack. When people lose their jobs, they go on short shift schemes. They've already started to push up to some degree. They are more likely to have multi-year pay deals. So inflation falling from 9 to 8 to 7 to 6 doesn't mean that workers don't stop asking for higher wages. And when you're setting wage numbers that might be 2 or 3 year deals, it takes a lot longer for wage growth to actually fall out of the system. So I think, yeah, they face different labour market challenges, but there are probably more rigidities in areas of the euro area than there are in the UK. In the UK, it's more of a supply issue.
So on the UK for a second, Rishi Sunak in Northern Ireland, if it's possible that we get a better deal here for Northern Ireland and that part of Brexit can be somewhat resolved, take into account then how some of the data is surprising to the upside, like retail sales today, could the UK economy actually be in a better place? Like, kind of my running commentary is like, man, the UK is in a bad spot. And how wrong could I actually be?
You're right. The retail sales figures were better. They were up 0.5%, but that only reversed less than half of the drop that we saw in December. The fact is inflation is absolutely taking its toll on the UK economy. The level of retail sales is still below, in volume terms, below pre-pandemic, but people are spending 14-15% more on it because of the inflation story. But absolutely, if we were to get any improvement in terms of trading relationships regarding our largest trading partner, which of course the EU still is, anything that reduces frictions, improves efficiency, that would be better. Anything that improved on the immigration side might ease some of these labour shortages that are actually starting to feed through. And also one other release that we've had in the last week in the UK was GDP. GDP in the UK they had good news on the headlines. It avoided recession. It didn't grow. It avoided recession. But thankfully, we did see some better numbers on business investment. The UK has lagged on business investment. That was revised up to some degree, which is a bit of a relief given that the super deduction is about to expire. So if we were to see more of this business investment feeding through, that would actually improve the supply side of the economy. And actually, our UK economists and UK analysts recently published a whole report on this topic. Will the lion roar again? Could it roar again? Thinking about some of the upside risks on the UK.
Or could it dodge a recession? Is there a possibility where you're reducing recession risks a lot when we talk about the euro area now? Could the UK avoid a recession?
Yeah, I think what markets are struggling with to some degree, and I get this question all the time, are we going to have a recession? Are we not going to have the recession? I get it about the UK, I get it about the US, I get it about the Eurozone. But remember, most people are thinking about a recession in the way that it has been for the last 2 or 3 decades, where you get a couple of quarters of negative GDP, you get rate cuts, and then you get a bit of a V-shaped recovery starting to feed through. We've got to remember that the UK's barely grown over the last year. Even the US has grown by less than 1%. So even if we get a year of 1% or 0% in the UK or the US or indeed anywhere else, and we don't get rate cuts, certainly we're not expecting rate cuts in 2023, and we've got sub-trend growth even in 2024 because of the lack of monetary easing, that will have been quite an extended period of very, very weak growth. It won't be the kind of short, sharp recession that we tend to get used to. I think, for all of these economies, whether it prints as an official recession with contracting GDP or not is not the question. It's how big a rise in unemployment are we going to see as a means of actually curbing inflation in all of these major economies.
So, Janet, based on that, how mispriced is the equity market right now?
Well, this is the interesting thing. Obviously, I'm just the economist.
Yes, I know, but still.
But the equity market, if it is priced on an expectation of interest rates coming down without a deep earnings recession, then that would be a world that has never really happened. Typically you don't get a sharp reduction in inflation from 9 or 10% to central banks' targets of around 2 without some significant rise in unemployment. So you would expect that to be associated with a deeper contraction in earnings than it seems is currently priced in.